Hello and welcome to the Accountant's Movie Review, where we sift through popular movies to find those accounting hidden gems within which other reviews have almost certainly left you without. We will continue here with the movie Ghostbusters. Ghostbusters being those individuals who founded a business trapping and storing ghosts. We will be focusing on the most motivating aspect of the business, which helps to get the Ghostbusters out of bed in the morning and carry on with the tedious task of ghost busting, that most motivating factor being the accounting. So we left off last time with the Slimer balance sheet here. We had the cash, we got the down payment on their place that they will be conducting business out of. That gives us our total cash down here. We had a loan on the books, and we had the equity section totaling $1,000 broken out in this way, which we will discuss again at a later time. That gives us total assets equaling total liabilities and owner's equity. Then the next thing that happens is they're going to purchase a sign to put on their building. So they have this new sign. We're going to say that that sign costs $450. It wasn't clear in the movie, but I'm going to say $450 for the sign. So the cash is then going to go down by the $450 here. And I'm going to put the sign on the books at miscellaneous expense. Down here, way down here in the bottom. And you might be saying, well, that's kind of lazy. Why would we put it into miscellaneous expense? Can't we categorize it somewhat better than that? And there's a couple factors in there. One is you might be saying, well, if the sign is attached to the building, and if it's substantial in cost, why don't we put it on as kind of part of the building? It should be capitalized as a leasehold improvement. And that could be a good point, but I'm not sure the sign is completely attached here, and if the amount is not relevant to the other amounts within, then it may be appropriate to expense it. And if we expense it down here, then there's a question of, the bookkeeper has the question, well, where should we expense it? Should we put it into possibly advertising? Should we create an account called sign expense? Or is it appropriate to put it into miscellaneous? And notice those are some questions that different companies may answer in different ways. If we think about what the trial balance would look like, we pull over the other numbers. This is what we have at this point. What does that do to our Slimer balance sheet? Well, cash has gone to here. Cash has changed. Down payment has stayed the same. Liability stays the same. And then our partnership equity total has changed. We won't talk about the breakout yet. We'll do that later. But the total assets equal the total liabilities and equities still. And if we want to see the backup for this number in the equity section, we can take a look at the Slimer income statement. So the Slimer income statement still has no income. We haven't made any income yet, but we have advertising expense and we have miscellaneous expense, adding up to total expenses of $1,450. And that gives us our net income or loss at this point, $1,450, and that's the full amount here because it's our first month of operations, and that's what is making up the partnership equity section. Next thing that happens is a new car. We get a new car. Ray drives in this new car. Peter over here is saying, who is this person driving this crazy car into our lot? And the new car that Ray purchases says that he purchased it for $4,800 within the movie. So cash is going to go down by that $4,800 to $54,275. We're going to put that on the books as an asset, auto an asset. And you might be saying, well, why isn't it auto an expense down here? Why don't we have it as auto expense? Reason being is because we have not yet used the auto in order to help us generate revenue. Therefore, we're going to put it on as an asset. We will expense it. We will expense it in the form of depreciation as we use it to help us generate revenue. Then this is what we have at this point in time. Next thing that's going to happen is that Ray says there's a couple things on the auto that may need some work, and he lists those out as being including suspension work, possibly shocks, brakes, possibly the steering box, maybe the transmission, and new rings and a little wiring. So it seems to me that Ray may have purchased this possibly in part as a hobby because it looks like he wants to do most of this work himself. But even if he does the work himself, it looks like there's a lot of parts in there. So I'm going to say that that's going to cost $1,500 on that. And that would bring down cash by $1,500. And we're going to put that into the auto expense here. And you might be saying, well, why don't we put that into auto? And that's a good question, because if we need to put these expenses in there in order to bring the car up to operation, and or if it's a substantial part of the car, substantial overhaul that will extend the useful life, then it's possible we should be putting it up here into auto. The car was driving when he first bought it, and I want to break out the difference between auto as an asset and auto as an expense, meaning that usually repairs and maintenance would go down here as an expense. So we're going to represent it as an expense to show that at this time. If we pulled over the other numbers, then this is what we have. We've got cash now, we've got the down payment, we've got the auto, we've got the loan on the books now. Now we've got the auto expense, we've got the advertising, we've got the miscellaneous expense, no income yet. Therefore, we have a net loss here. And of course, our debits equal our credits at this point. A couple other things that happen of note at this point, and that is that we have a new employee, Janine, here. Not much business going on, so the phone's not ringing too much, so she does a lot of reading at this point. But we do have a new hire. Now notice when we first hire the employee, we're not going to put any transaction on the books because there's no transaction until the payroll period ends when we actually pay the employee. So when we first bring the employee in, no transaction at that point. But we do have a new employee, and that is exciting. And we have our first potential client here, and that of course makes Peter very happy for multiple reasons. So he's going to meet the new client. Now, once again, there's no transaction here because really what's happening is they're kind of doing a bid for the job, seeing if there's something that they could do for Dana here in terms of catching ghosts. And therefore, the bidding process, there's no transaction that's going to take place. No work has been done. No revenue has yet been earned. Hopefully, it will soon in the future. So that means that as of now, our Slimer balance sheet has cash of $52,775. It's got the down payment here for the building. It's got property, plant, and equipment of the auto. Notice we're going to break out the property, plant, and equipment separate from the current assets because this is a more long-term asset. If we add these two up, then the current assets and the long-term assets, we get to the the total assets of $65,575. We've got our liabilities still on the books of $68,525, and we've got our total equity here of $2,950. We'll talk about how that is broken out in a second, but for now we want to note that the total assets equal the total liabilities and equity, and to back up of this number here in the equity account, we can look at the Slimer income statement. So here's the Slimer income statement. No income, sadly, yet, but it's going to happen. We know it. And then we've got the auto expense, we've got the advertising, the miscellaneous. So we have total expenses here. Assets minus expenses gives us this number there. And that number is what is in our balance sheet at this time because it's our first year of operation. Now, if we're assuming that this is the first full year of operation, if at the end of the year, if this is where we had left at the end of the year and we had a loss of $2,950, and we look at our statement, our Slimer statement of partners' equity, then let's think about Ray's first. We got to allocate that loss out to our three partners, Egon, Ray, Peter. And we're going to say that Ray, we're going to assume that they have a partnership agreement basically saying, Ray, we're going to give you more. Why? Because you put down collateral on the loan, taking on a lot more personal risk. So that loan was for $68,525. We're going to allocate to you 10% of that each year. So after the year is over, we'll allocate 10% of that, meaning we're going to give you $6,853 of the net income allocated to you before we split the rest out evenly between the three of us. And you might say, well, how would that be possible if we have a loss? How can we allocate income to someone when we lost money? Well, we could say, okay, Ray, we're going to allocate income of $6,853. Then we're going to figure out what we need to do to allocate the loss to the rest of us, to the three of us, in order to get to the loss. So to calculate that, we would then say that Ray is going to get $6,853 plus the loss, which totaled this $2,950, and we're going to allocate that evenly between the three partners by dividing by 3, and that gives us the 326. I'm going to say 68. So 3268. So Egon's going to be 3268 allocated if an entire year had passed and there was a loss of 2,950. Egon would owe the company 3268. Ray, we're going to allocate the 3268 as well, but Ray already had been allocated this 6853. So if we net those two out, then Ray actually has a positive balance from the partnership of 3585. Peter then is going to be allocated 3268, meaning Peter owes the company this 3268. And if we add these three up, then that's going to give us our allocation of income at this time, which would appear on the balance sheet. That's how we're getting this breakout for this equity, which is basically just the net income at this time. Going forward, we're going to talk about the last part of the petty cash. This is their last meal of petty cash before they get any clients. So that's a stressful moment. We have our first actual client that pays them, which is a good moment. And then we're going to have a new employee when they start getting more business. We're going to have a new employee to help out with that growing business.